you.
Good morning.
So, sir, just talk to us about growth first off. You've guided for around a 25% growth number for FY25. You far exceeded that in Q1. It's been a very strong Q1, which is seasonally, generally, the kind of the weaker quarter for the larger lending industry. Talk to us about what are the growth trends and how will rural also affect the numbers? Can we expect a higher number in terms of guidance on AUM growth?
We have got into multiple products, as you know, and in most of the products we are seeing good growth, especially LAP and home loans, which we have gone geographically wider. Vehicle finance has done a good job this time, but there is still a lot more can be done here because the rural economy, as you rightly pointed out, is yet to pick up in its full earnest. The monsoons have been predicted to be good, and so we expect that to grow well. And we will see growth in the new businesses also, which is the CSL, SBPL, and SME. These have been growing, pretty steadily over the last year, and this quarter also has shown good growth. So we expect growth to be around the same 25-30%. I don't want to commit right now much larger than that. Right now, we will see how Q2 happens. Q2 also is generally a dull quarter because large part of the country comes under monsoon. And also there are some inauspicious periods during this quarter, which tends to reduce the economic activities, at least in vehicle finance and related businesses. So we will watch Q2 and then come with a more, clearer and a more steady growth projections. Right now, let's stick with the 25%. Maybe around 25 to 30% is what we can right now target.
Understood, sir. Sir, the couple of concerns that at least I found, one is with regard to margins. You had guided 7.8 will hold when the last time we spoke at the end of Q4. We're at 7.6 currently. Do you expect that to go back to 7.8 on higher margin products, or you're expecting some bit of tepidness in margins compared to what you were looking at last quarter?
No, we are trying to reach the 7.8%. We will be there, I presume. And as you look at it year on year, the numbers I gave last time also was more from an year-on-year perspective. And we expect the yields to further improve. We have talked about that the vehicle finance book should change its contour with larger, yield share going up as the old book runs off and the new book comes into play. And we have also been doing more of used and higher yield products in vehicle finance, which should, push the yields up. The rest of the new products will also start, increasing their share in the NIM. So that would also help us to move the NIM. So we should still stick to the 7.6 to 7.8% target for the NIM. Having said that, the cost of funds drop that was expected in the second half may not happen, as you all know, but we are still trying to hold it at that levels right now to make sure that we have these improvements in it.
Understood. So on the provisioning side of things, you've seen a bottoming out. Is this now a revert back to normal, you would call, or has there been a higher provisioning than what you would have also anticipated, because the number is substantially higher?
Yes. See, we had reached the pre-COVID levels in March. This is the trend which used to be in the pre-COVID period, that we will tend to slip a bit in Q1, where because of the large pressures in the Q4, there would be some slip backs in the NCL as well as the NPA numbers. While it will remain at similar levels in Q2 and start improving in Q3, Q4. This used to be the trend pre-COVID, because in COVID period, the levels went up significantly higher and there were these management overlays, etc. coming into play. That trend was not visible over the last 2 to 3 years. But I think we're back to the pre-COVID sort of a situation where you will see this trend happening. You will see NCL numbers reducing in Q2, but NPA numbers similar to what we are seeing in Q1. And in Q3, Q4, you will see both of them improving.
Understood. Okay, so only getting better from here. Is that how you would put it?
Yeah, but you have to wait for a quarter or so.
Sure. Yes. Okay.
Improvements will be visible. Yes. Yeah.
Sure. Point taken. So with regard to capital adequacy, you are at 18% currently. You're growing at 25-30%. I appreciate that profitability likely will continue to hold up, which should aid capital adequacy, but 25-30 is still very, very strong just in terms of your growth. Any plans to raise capital this year?
We don't need to raise capital. If you again observe the capital adequacy in its entirety, you'll see the rundown has been more in the Tier 2, where we had repaid large parts of the sub-debt and perpetual debts over the year, which we have raised. And we have adequate capital in the Tier 1, both from the pure equity as well as on the convertible debentures, which we are holding right now, which will be falling due for conversion shortly. So with these, I think on the Tier 1, we are pretty confident of holding our position much above the regulatory norm and as well as the internal norms we have guided for. But Tier 2 we will be raising. We have raised already in July some parts of Tier 2. We will raise some more as we move through the year. So that would keep the capital adequacy, at an overall level, well ahead of the regulatory norm that's prescribed, and we should be able to fuel our growth with that.
And if one were to foresee, when would an equity raise come into play? Would it be FY26?
No, FY26 is when the conversion of the debentures which we are holding will happen. At that point in time, we will also evaluate. Actually, we have already stated that, if the capital adequacy drops below 17, we would be certainly raising capital, and we will do that. But as I said, there is large headroom on Tier 2, which we should be able to tap. That is a good amount of demand for Tier 2. Chola papers are well accepted in the market. So we will do the Tier 2 raising. And if Tier 1 by itself is coming below the threshold of 13%, then we will certainly raise the capital.
Okay. And with regard to ROAs, therefore, your aspiration was PBT ROA of roughly 3.4%, if I recall last we spoke. Would that at all change given the margin, given the provisioning, given this entire environment? Would that guidance at all change?
No, we are still working towards the 3.4-3.5% ROA pre-tax for the full year. So these are like quarterly aberrations which you would have seen even in the past. And we should be there for the full year, 3.4 to 3.5% pre-tax ROA.
Okay, so I take your point. So on the provisioning side, is there a specific pocket where you've seen pain? Could you talk to us about some trends that you're witnessing on ground, just to help our viewers get context?
See, our vehicle finance book has seen a little bit of a higher provisioning. Primarily, this happens in Q1 and Q2 when the borrowers who are small road transport operators and don't have deep pockets get impacted either because of the seasonality, rains, or in the first quarter for this year, for example, because of the elections as well as the heat wave. But they will come back in Q3 and Q4 when economic activity sort of spurts with festivities coming into play as well as the harvesting coming into play. That's when they have larger revenue in their hands. They will start utilizing their vehicles more than 80-90% capacity, which will give them adequate liquidity or earnings to pay not only the current EMI but also any past dues, if any. So that would help them to reduce their outstandings and delinquencies, and also help us to reduce our provisioning and our NPA numbers.
Understood. So thank you so much. It's been a pleasure speaking with you, understanding all of those metrics.
Thank you.
Right. So President CFO at Cholamandalam Investment and Finance, Mr. Arul Selvan. Anyway, with that, completely out of time on this one. Stay tuned to NDTV Profit. We'll slip into a short break. More on the other side.